We've been cautious on Australian equities and we maintain this stance. While there are pockets of support, the domestic backdrop faces several meaningful headwinds that are likely to keep the ASX 200 bouncing within its 12-month trading range of 8,400 to 9,100 for some time yet. We know being cautious has now become a consensus call amongst the sell-side brokers, and this does make us nervous because the consensus has had a horrid track record in recent years. But there is a time to be anti-consensus, and we don't think the risk-reward suggests that time is now. Instead, we think all the action will take place below the headline index level. In a rising market, what you don't own is not so important to overall returns because the sheer weight of stocks rising will lift all boats. But in a range-bound market, what you don't own takes on more relevance because there are not as many stocks moving higher. And that's why avoiding the underperformers will remain important until it's time to position for the next upswing. We think there are 4 key headwinds that will keep the market volatile and range-bound. First, tight monetary policy remains in place. Even with the RBA on hold, cost of living pressures on households will continue. Second, consumer confidence is weak, and the sudden stop in the housing market will further undermine the spending backdrop through the second half of the year. Third, key parts of the equity market are under cyclical and structural earnings downside risk. This includes banks, selected consumer discretionary stocks, and healthcare. And fourth, Australia doesn't have enough technology exposure to support the overall index, and that exposure is mostly in software, which remains under structural pressure from AI. We know outlining the headwinds is only half the story. There are key positives for the equity market, but we don't think these are broad enough to carry the entire market higher, even if they will provide support at a stock-specific level. To recap, Australia doesn't have a valuation problem, and in fact, we've never thought this was the case, even when it was trading on peak multiples of 23 times. There is no aggregate derating pressure on stocks. In addition, falling energy prices will alleviate some inflationary and cost pressures as we move deeper into the year. But perhaps the most important tailwind will come from a resilient global economy, which has sustained itself during the recent Mideast turmoil, as well as the AI capex cycle, which continues at pace and is now dragging in stocks and sectors that operate both upstream and downstream, including power infrastructure and electrical equipment, servers and racks, networking interconnectivity, as well as picks and shovels exposure, such as the miners who provide critical minerals. While this is a reasonable list of positives, we see global tailwinds as supports for downside risk rather than driving upside potential, particularly as domestic concerns remain front and centre. No one likes a volatile and range trading market, and no one likes it when large parts of the index are facing downside risks. But before we start the next upswing, which will be measured in years rather than tactically, and before we start to factor in rate cuts by the RBA, we have to swallow the medicine that will get inflation back to more comfortable levels. And if a range trading market is the worst it gets, then this is not too bad, and the lucky country will again be very lucky to have escaped another tightening cycle alongside a drastic policy change at a federal level with just a few scratches.